So I think a lot of this inflation risk concern needs to incorporate this idea that monetary policy is very important. Well, crossing $100,000 today took us to roughly $2 trillion. So we're well on our way. Ringing the bell for a new asset class. How big could that be? If this new asset class with low correlations of returns and risk relative to other asset classes, all fiduciaries have to look at this new asset class.
Is Bitcoin the new reserve currency of the world? Cathie Wood just dropped bombshell predictions about Bitcoin crossing $100,000 and why it's only the start. Plus, she connects the dots between deregulation, economic innovation, and a deflationary boom. Stay tuned as Cathie Wood explains how digital assets like Bitcoin are rewriting financial history. You don't want to miss this.
Deficits and government spending and the role that they play in inflation. And one of the things I'd like to illustrate with the charts is that deficits or government spending has to be funded, that monetary policy has to accommodate government spending, or if it does not, then government spending crowds out the private sector. So I think a lot of this inflation risk concern needs to incorporate this idea that monetary policy is very important as to whether government spending and deficits result in inflation. And if monetary policy is willy-nilly and just is accommodating everything, then yes, inflation will be a likely outcome. But if monetary policy is not supporting government spending and is restrictive, as Jay Powell, we think, correctly identifies it or describes it now, then what happens is government spending really crowds out the private sector. So I started in the business while I was in college in the late 70s, when this was the issue. Government spending was crowding out the private sector and monetary policy was accommodating it. We had the worst of all worlds back then. That's not where we are right now. But we do think, as I mentioned before, government spending is taxation. And if Doge is going to be successful and monetary policy remains disciplined, then we can look forward to the private sector increasing as a share of GDP, especially as the incentive system associated with lower tax rates encourages innovation. So pretty excited about that. As you've heard on In the Know before, we do believe that between now and 2030, real GDP growth will accelerate to the 6 to 8% range. And that might be conservative because of all of the innovation that now is going to be incentivized and encouraged. But what we also think is that inflation is going to give way to more deflationary forces associated with technology. The technology that's evolving today is highly deflationary, but in the good sense. Deflation, because of 08-09, that collapse has a bad connotation. The good connotation of deflation is associated with technology and innovation. So we think this is going to be a win-win going forward. Here is what the CBOE is expecting in terms of real growth. So Scott Bessent taking it to 3% is quite a bit above. And our expectation of growth potentially in the 6 to 8% would put it in the outer regions of what we have seen in history, in post-World War II history. But we do believe that innovation is ripe now to take us there and will be a great antidote to the deficit expectations. Innovation is going to stir productivity in a way we haven't seen before over an extended period of time. So we wouldn't be surprised to see productivity growth in the 4 to 5% range consistently, not just cyclically, but consistently as the 5 innovation platforms, robotics, energy storage, artificial intelligence, blockchain technology, and multi-omic sequencing evolve and move into prime time time, and more important, or as important, the convergence among those technologies, as we'll see with autonomous taxi networks. Autonomous taxis are robots, the combination of robots, energy storage, and artificial intelligence, three major platforms coming together and creating booms, we think, in productivity. You can see that other three, the 3 extra million barrels of production. So you can see under President Trump, his first term, 2016 to 20, we went from roughly 8.5 million barrels a day to 13. COVID interrupted it. We basically got back to 13 recently. I think we'll get back on that trend, that steep trend line that we saw before COVID, and 3 million barrels up to 16 by 2028. I think that will be an easy one. And it will feed this deflation argument that we've been making for some time. The CPI, after basing a bit, did step down in 2024. We know there are always base effects that can cause a plateauing, but we think that within the next year or so that we will see inflation below 2%, and that it will continue to go beyond that. Wouldn't be surprised to see it in the negative territory as oil prices come down like they did in 2020. We're in negative territory there. And again, in 2014, that was European sovereign debt crisis. We know Europe is in a world of hurt. We know China is having trouble getting out of its troubles, its property troubles. So again, there are deflationary forces associated with economic weakness, and there are deflationary forces associated with technology that are going to build and intensify during the years ahead. So again, we wouldn't be surprised to see inflation below zero.
Cathie highlights a critical economic shift fueled by deregulation and innovation. She explains how key technologies, including Bitcoin and AI, are driving a new era of growth, with potential rates of 6 to 8% by 2030. Despite restrictive monetary policies, innovation creates deflationary forces, reducing costs and boosting productivity across industries. Drawing comparisons to the 1920s, she envisions a modern-day multi-platform revolution encompassing blockchain, renewable energy, and robotics. Additionally, Cathie outlines how an inverted yield curve signals a shift back to periods of innovation-led deflation, where long-term rates remain lower than short-term ones.
And so where will equilibrium in this new world be? Well, if we're right and real growth goes up dramatically, say to that 6 to 8% range, but inflation keeps coming down, we could be back to an environment where long rates will be in a consistent way lower than short rates. Short rates might go up to that 6 to 8% range, but long rates, looking at the deflationary ramifications of innovation, long rates could be much lower, as they were during the 50-year period that ended in the Roaring 20s. Long rates were about 100 basis points below short rates for most of that time, and at times were down 500 basis points below short rates. Why is that period important? It is because that's the last period where we had massive innovation, multiple innovation platforms evolving at the same time. And then here is an exciting chart. We hit and crossed $100,000 on Bitcoin this week. That's a big deal. As many of you know, we've been involved with Bitcoin since it was $250 in 2015 when we wrote our first white paper on Bitcoin in collaboration with Art Laffer. And I remember back then saying to Art when he said, "This is what I have been waiting for since the gold window closed in 1971. And I said to him at that point, and remember, Bitcoin was $250. I said, "Art, this sounds like a big idea. How big could it be?" And he said at that time, "Well, how big is the US monetary base? That's the reserve currency of the world. This seems to be the new reserve currency of the world." I said, "Well, back then it was $4.5 trillion. Today it's about a little over $7 trillion. Well, crossing $100,000 today took took us to roughly $2 trillion. So we're well on our way. He has come back to me and he said, well, wait a minute. Before 2008, the monetary base was $750 billion. That's all we needed for the reserve currency back then. And what we've gone back to say to Art is, yes, if we were just looking at it as the world's reserve currency, you might be right. But we're looking at it in many other ways as well. It's a substitute for gold, a store of value. Gold is a $15 trillion asset. It is a new asset class, or as we named our paper in 2016, the one we did in collaboration with Coinbase, ringing the bell for a new asset class. How big could that be? If this new asset class with low correlations of returns and risk relative to other asset classes, all fiduciaries have to look at this new asset class. And so we think it could become, 2 to 5 or 6% of portfolios. It's also an insurance policy in emerging markets for populations who are used to, whether it's corruption or inexperience or what have you in terms of fiscal and monetary policies, but, collapses in currencies and outright confiscation of wealth or capital controls. So this is ideal as a hedge against those scenarios, and even for high net worth individuals around the world. You never know.
There you have it, Cathie Wood's vision for a world reshaped by Bitcoin and innovation. From Bitcoin at $100,000 becoming a reserve currency to the dawn of a new digital asset revolution, the future has never looked so dynamic. Don't forget to like, subscribe, and hit the bell icon for more game-changing insights from industry leaders. What do you think? Is Bitcoin the hedge we all need? Comment below. We'd love to hear your take.